This tutorial is a quick introduction to investments. What are investments? Investments are financial assets on our statement of financial position. Companies invest excess cash flow into investments to earn a return either through cash flows through the life of an investment, such as through dividends, capital appreciation by selling an investment for more than they purchased it for, or potentially both. There are two types of investments. There are debt investments and equity investments. Debt investments, you are a creditor of the issuing company. You usually pay cash up front and receive the right to receive interest and repayment of capital at the maturity date of the debt. There are two types of debt, interest-bearing and non-interest-bearing. Interest-bearing debt is where you are receiving a coupon payment over the life of the debt, as well as repayment of capital at maturity. Non-interest-bearing debt, you do not receive a coupon payment over the life of the debt, but the difference between the amount paid for the debt upfront and the amount that you will receive at the maturity of the debt make up for the lost interest payments over the life of the debt. Equity investments represent an ownership interest in the issuing company. They include common shares, preferred shares, and other capital shares. These investments do not have a maturity date and do not pay interest. Normally, the company pays cash up front and receive various rights, such as voting rights, potentially dividend rights, and the right to residual assets upon liquidation. How are investments measured? Investments are mostly measured investments have historically been measured at the historical cost model. However, there are significant problems with the historical cost model in terms of providing relevant information. This is especially important in terms of investments, where the historical cost of the investment could have significantly changed compared to the current market value. As a result, standard setters have put standards into place which require many investments to be measured at fair value. IFRS 9, which is effective January 1st, 2018, specifically requires companies to follow measurement models dependent upon the purpose to which they are managing the investments. There are three measurement models for valuing investments. There's amortized cost. In this model, the investment is carried on the balance sheet at amortized cost, which is the original cost adjusted for the amortization of any premium or discount. There are no fair value adjustments under the amortized cost model. The investments do, however, require to be tested for impairment. The next model is fair value net income and fair value OCI. You'll note these are both fair value based models. The investments will be on our balance sheet at fair value. The difference between the models is where the change in the fair value will flow either to net income or to OCI. Check out our next tutorial as we go through each of the measurement models in detail, as well as look at a numerical example.